वेलकम टू वी लर्न में आपका स्वागत है। सब्जेक्ट फाइनेंशियल डेरिवेटिव, सेशन नंबर 6, इन्वेस्टमेंट बैंकिंग। दैट मीन्स हाउ टू इन्वेस्टेड बाई बैंक और हाउ टू इन्वेस्टेड इनटू द बैंक। इस सेशन के अंदर बैंक किस तरह से डेरिवेटिव करता है वो सब चीज़ आपको समझाई जाएगी। टॉपिक्स कवर्ड in this session: derivatives used by bank, derivatives pricing, derivatives market in Pakistan. Now derivatives, some say the world will end in fire, some say in ice. Called by Robert Frost 1874 to 1963, दिस इज वाट द डेरिवेटिव वर्ल्ड इज। तो उन्होंने इस तरह से इसको डिफाइन किया है। नाउ फाइनेंशियल इंस्ट्रूमेंट हुज प्राइस इज डिपेंडेंट अपॉन और ड्राइव्ड फ्रॉम द वैल्यू ऑफ अंडरलाइंग एसेट्स। द अंडरलाइंग नॉट नेसेसरली हैज टू बी एन एसेट्स, इट कुड बी एनी अदर रैंडम or uncertain event like temperature, weather, rainfall, etc. The most common underlying assets include stock, bond, commodities, currencies, and interest rate. All these 5 things are very volatile, and we can hedge the risk by using the financial derivative. Financial derivative as a broad. Derivatives are mainly used to mitigate future risk. However, they do not add value since hedging is a zero-sum game, and secondly, investors mostly use them on do it yourself alternative basis. That means investors जो है अल्टरनेटिव बेसिस पर अपनी मर्जी से इन चीज़ों को यूज करते हैं। डेरिवेटिव्स मार्केट कैन बी ट्रेस्ड बैक टू मिडल एज। दे वर डेवलप्ड टू मीट द नीड्स ऑफ फार्मर्स एंड मर्चेंट्स। फर्स्ट फ्यूचर एक्सचेंज वाज एस्टेब्लिश्ड इन जापान इन 16th century. द शिकागो बोर्ड ऑफ ट्रेड वाज एस्टेब्लिश्ड इन 1848. द इंटरनेशनल मॉनेटरी मार्केट वाज एस्टेब्लिश्ड इन 1972 for future trading in foreign currency. Insurance is a kind of mitigating risk, but it has its limitations. To avoid zero NPV, it tries to cover administrative cost, adverse selection, and moral hazards risk in its premium. Apart from this simple format, the derivatives on the other hand have lot of varieties, that is from simple to highly exotics, creating a world of their own. Size of its activities are manifold as compared to total world GDP. International markets and their risk. In global world, foreign exchange markets of each country play an important role. The market embodies a spot market with a forward market. The forward market represents the selling and buying commitment or due on some future dates. To understand the dynamics of foreign exchange market in Pakistan or in any country, we have to understand the difference and relationship between exchange rates and interest rates. This gives birth to 4 questions. Number 1, why the dollar rate of interest is different from, say, Pakistan or any other country? Number 2, why the forward rate of exchange is different from the spot rate? Number 3, what determines next year's expected spot rate of exchange between dollars and other nations' currency? Number 4, what is the relationship between inflation rate in the US and the inflation rate in Pakistan. Suppose that individuals are not worried about risk or cost to international trade, then difference in the interest rate, which is equal to 1 plus R upon 1 plus R, must be equal to expected difference in inflation rate, which is equal to E 1 plus inflation rate of any nation divided by E 1 plus inflation rate into other nation. Further difference between forward and spot rate equal to forward minus other nations rate upon S minus other nations rate must be equal to expected change in spot rate, which is equal to ES minus other nations S divided by S minus other nations S per dollar. International market and their risk. Interest rate parity theory says that the difference in interest rate must be equal to the difference between the forward and spot exchange rate. Therefore, 1 plus R divided by 1 plus R in dollar, or 1 plus R of one nation's currency divided by 1 plus R of other nation's currency, which is equal to difference between the forward and spot exchange rate. In case of Pakistan, it would give the following results, which is equal to 1.12 divided by 1.01 multiply 85, which is equal to forward rate of the nations divided by dollars after 1 year, which is equal to 94.25. Expectation theory of exchange rates tells us that the difference in percentage between the forward rate and today's spot rate is equal to the expected change in the spot rate, equal to difference between forward and spot rate, which is equal to forward minus other nation's currency in dollar divided by S minus other nation's currency in dollar, which is equal to expected change in spot rate E S into other nation's currency in dollar divided by S into other nation's currency in dollar. Purchasing power parity implies that difference in the rate of inflation will be offset by a change in the exchange rate, which is equal to expected difference in inflation rate equal to E 1 plus inflation minus other nations inflation divided by E plus E into 1 plus inflation minus US inflation, which is expected change in spot rate equal to E spot minus other nations divided by dollar divided by S minus other nations divided by dollar. This would give a result of rupees 90.77 divided by US dollars. Considering inflation in other nations as 10, in US as 3, and spot rate of other nations divided by USS as rupees 85. However, life is not very simple, and apart from these exercises, inflows and outflows mostly dictate the spot and forward rates, then can alter. Derivative market, exchange trade contract and over the counter market. ये दो तरह के हमारे मार्केट हैं. Exchange trade contract means the contract which are traded by the stock exchange is known as exchange trade contract, and the contract which is traded by the OTCI, over the counter exchange of India, they are called over the counter market. So market participant, hedgers face risk associated with the price of an assets. They use future or options market to reduce or eliminate this risk. Speculators Speculators wish to bet on future movement in the price of an assets. Derivatives can give them an extra leverage to enhance their returns. Arbitrators Arbitrators work at making profits by taking advantage of discrepancy between prices of the same product across different markets. Types of financial derivative can be plain, vanilla or exotic, like forward contract, future contract, options, forward rate agreement, swaps. Now forwards. Forward contract is binding contract which fixes now the buying oblique selling rate of the underlying assets to be bought or sold at some time in future. This can be divided in two different categories. Number one, long-term forward rate. Under long-term forward rate, binding to buy the assets in future at the predetermined rate. Number two, short forward rate, binding to sell the assets in future at the predetermined rate for short period of time. Basic features: long or short, payoff, binding contract, OTC transactions or contract, risk uncertainty elimination, zero cost product, and credit risk. Payoff equal to ST minus K for the long forward, payoff equal to K minus ST for short forward, where T time to expiry of the contract, ST spot price of underlying assets at time T, K strike price or the price at which the assets will be bought or sold. Forward contract payoff, like as the figures, long-term positions. Under long-term positions, the payoff is built upon x-axis origins up to the tails of the y-axis, and the initial value of the contract is 0. So the price is determined on intersection point of the line S and the line of long-term derivatives, which is equal to K. So the price of derivative is 0K on long-term positions, and short-term position just opposite of it. The line, blue line, is starting from the y-axis to the x-axis, and 0S line is the initial line of the contract, and the price is determined on the point of K, and the price of the options or price of the contract is 0K on y-axis, whereas in short positions the price is below the line rather than short-term positions. Futures. A futures contract is a standardized contract traded on a futures exchange or any stock exchange to buy or sell a certain underlying instrument at a certain date in the future at a specified price. A specification of a standard contract like gold, commodity name, exchange name, size of contract like 100 ounce, delivery month February, April, June, August, October, December, whatever the suitable month. Then distinction between futures and forward contract. Forward contract traded in dispersed interbank market 24 hours a day, lacks price transparency, whereas futures traded in centralized exchange during specified trading hours exhibits price transparency. Number 2, under forward contract, transactions are customized and flexible to meet customers' preferences, whereas in future, transactions are highly standardized to promote trading and liquidity. Number 3, under forward contract, counterparty risk is variable, whereas under future contract, being one of the two parties, the clearing house standardized the counterparty risk of all contracts. Under forward contract number 4, no cash flows take place until the final maturity of the contract, and future On a daily basis, cash may flow in or out of the margin account, which is marked to market. Margin requirements or daily settlement. Initial margin. An initial margin is the deposit required to maintain either a short or long-term position in a futures date or contract. Maintenance margin. Maintenance margin is the amount of initial margin that must be maintained for the position before a margin call is generated. Margin call. If the amount actually falls below the maintenance margin, a margin call is given to the investor to replenish the account to the initial margin level, otherwise the account is closed. Variation margin. The additional funds deposited to make up to the initial margin is called variation margin. Futures price close to expiry. In the delivery month, the futures price is almost equal to the prevailing spot price, or we can say that with the passage of time the futures price gradually approaches the prevailing spot price because of no arbitrage principle. No arbitrage principles. Assume notation T equal to delivery expiry time of the futures contract, F0 equal to futures price now to be delivered at time T. ST spot price of the underlying at delivery time T. If F0 greater than ST, there is an arbitrage opportunity. Short the futures contract, buy the assets and make the delivery, and the payoff equal to F0 minus ST greater than 0. If F0 less than ST, parties who want to buy the assets would immediately go long the futures contract and wait for the delivery. Because of increased demand for the futures price would go up to the actual market spot price of the assets to remove the anomaly. Hedging strategy. Short hedge. When the hedgers own an assets or expects to own an assets in future and want to sell it. By shorting an appropriate futures contract, the hedgers can lock in a price now to sell the assets at some time in future. Hedging with futures. Suppose commitment to sell 1000 barrel after 3 months at the then prevailing spot price says ST, futures price for delivery after 3 months equal to 18.75, and strategy, go short a 6-month future contract to lock in a price now. At maturity go long a futures to close positions. Hedging with futures. Long hedge. When a company knows it will have to purchase a certain assets in the future and want to lock in a price now. By going long an appropriate futures contract, the hedger can lock in a price he will be paying after time T to buy the assets. Suppose commitment to buy 1000 barrel after some time T at then the prevailing spot price says ST and future price 18.75. Then the strategy, go long as 6-month future contract to lock. Scenario, if ST equal to 19.5, price paid after 6 months at spot price rate 19.5 and gain or loss on future 19.5 minus 18.575, which is equal to 0.75. If ST equal to 17.5, then price payable after 6 months 17.5, then gain or loss 17.5 minus 18.75, and if ST equal to 18.75, then payable after 6 months 18.75, then gain or loss 0. Brinks Bank, a bank with a history of 233 years, collapsed because of imprudent use of derivatives. One of the traders, Nick Leeson, who was basically responsible to mark arbitrage profit on stock index future on Nikkei 225 on the Singapore and Osaka exchange. Instead of looking for arbitrage opportunities, the traders started making bets on the index and went long the future. Unfortunately, the market fell by more than 15% in 1995, leading to margin calls on his positions. Because of his influence on the bank office, he was able to hide the actual position and sold options to make for the margin calls. But his view on the market proved to be wrong and losses mounted to an unmanageable amount. Metal Gas Sale, a US subsidiary of a German company, used hedging strategy which went against them, resulting in heavy cash outflows. Being an oil refinery and marketing company, they sold forward contract on oil manufacturing up to 10 years. To hedge their position, they went long the available futures contract with maturities up to 1 year. They planned to use stack and roll strategy to cover their short forward contracts. But due to decreasing oil prices, they had margin calls on their futures contracts. They were unable to meet those heavy cash outflows. Ultimately, the US team of the company were kicked out and a new team from Germany came to USA and liquidated the contract, making heavy losses. Options. An option is a contract that gives the buyer the right but not the obligation to buy or sell an underlying assets at a specific price on or before a certain date. Unlike a forward or future, this contract gives the right but not the obligation, so it's not a binding contract. The holder will exercise the option only if it is profitable. Types of option. On the basis of payoff structure, we can bifurcate options into two categories. Number one, call option. A call gives the holder the right to buy an assets at a certain price within a specific period of time. Whereas put option, a put option gives the holders the right to sell an assets at a certain price within a specific period of time. Strike price terminology. The type of options and the relationship between the spot price of a underlying assets and the strike price of the options determine whether an option is in the money, at the money, or out of the money. Exercising an in the money call or in the money put will result in a payoff. Neither a call nor put that is at the money will produce a payoff. In the money, call option spot greater than a strike rate and put option spot less than strike rate. At the money, spot equal to strike and spot equal to strike in both the cases, either put or call. Out of the money, call option spot less than strike and put option spot greater than strike. And payoff, strike price, profit and loss, then spot price is on 0 and the premium is goes from loss to the strike rate, and strike rate for long calls in first figures, and second figures is just opposite for the long put, and third for short call premium, that means more than the spot price, then strike price, short call, then strike price premium on short put. And now types of option. On the basis of exercise options, they can also be divided into different categories like American option. American option can be exercised at any time between the date of purchase and the expiration date. Mostly American options are exercised at the time of maturity, but when the underlying makes cash payment during the life of option, early exercise can be worthwhile. And second, European option can only be exercised at the end of their lives on the basis of versatility. Next one is vanilla option, a normal option with no special or unusual features. Number 4, exotic option, a type of option that differs from common American or European options in terms of underlying assets or the calculation of how or when the investors receive a certain payoff. Next one is a Bermuda option, a type of option that can only be exercised on predetermined dates, usually every month. Then compound options, and options for which the underlying is another option, therefore there are 2 strike prices and 2 exercise dates. These are the 4 types of compound options, like call on a call, put on a put, call on a put, and put on a call. Next is attitudes Asian options, and options whose payoff depend on the average price of the underlying assets over a certain period of time as opposed to at maturity, also known as an average option. Next one, digital options, and options whose payout is fixed after the underlying stock exceeds the predetermined date or strike price, also referred to as binary or all or nothing option. Next one is a shout option, an exotic option that allows the holders to lock in a defined profit while maintaining the right to continue participating in gains without a loss of locked in monies. Next one, barrier options, a type of option whose payoff depend on whether or not the underlying assets has reached or exceeded a predetermined price. And now, do it yourself. What is the difference between swap and option? Number 2, what is forward contract, how it is differ from future contract, and that's it from session number 6. Thank you.